Physical silver just hit $96 an ounce in Dubai. Not on COMEX, not in London. Dubai. Meanwhile, COMEX silver futures move 5% overnight to $41.80. That's a 129% premium for physical delivery in the Middle East, while paper markets in New York pretend everything's normal. And if you think that spread is just regional pricing, you're missing the fracture that's about to split global markets into two separate realities. What if I told you Dubai isn't an anomaly? What if this 96 price is what silver actually costs when you demand physical metal instead of paper promises? What if the 5% move on COMEX, celebrated as volatility by traders, is actually the paper market's death rattle as it loses all connection to physical reality? Look at what's happening right now. You can buy silver futures on COMEX for $41.82 and take delivery in 6 months. Or you can buy physical silver in Dubai for $96 and take delivery today. The arbitrage should be instant. Buy paper, sell physical, pocket $54 per ounce. Except nobody's doing it. Because COMEX can't deliver physical silver in quantities that matter, and Dubai buyers know it. Drop a comment. Where are you watching from? Because this price divergence connects every currency, every commodity market, every promise your government made about financial stability. Hit subscribe for the unfiltered truth about what happens when paper markets separate from physical markets and trillion-dollar derivative positions become worthless overnight. Let me show you the fracture that changes everything. December 30th, 2025, 11:34 p.m. Dubai time. The Dubai Gold and Commodities Exchange reports physical silver transactions at AED 352 per ounce. That's $95.84 in US dollars, not futures contracts, not certificates. Physical 1 kilogram bars changing hands in vaults with same-day settlement. Volume is thin, only 340,000 ounces traded, but every transaction clears at $96 with zero discount for bulk purchases. 6 hours later, COMEX opens in New York. March silver futures close at $41.82, up 5.1% from the previous session. Financial media celebrates the move as a strong rally driven by industrial demand outlook. Nobody mentions Dubai. Nobody mentions the 129% premium. Nobody asks why physical silver costs $96 in the Middle East while paper silver trades at $41 in New York. Sound familiar? This is the same fracture that appeared in gold markets in 1968 when the London gold pool collapsed. Official gold price was $35 per ounce. Physical gold in Paris traded at $44. The spread revealed that central banks couldn't supply enough physical gold to maintain the peg. 3 years later, Nixon closed the gold window and the dollar became pure fiat. Silver is doing the same thing in 2025, except this time it's not governments breaking the system. It's sovereign wealth funds, industrial buyers, and private wealth in the Middle East demanding physical delivery and discovering that Western paper markets are running on fumes. The 96 price in Dubai is the market's way of saying paper promises are worthless, physical metal is priceless. But there's a deeper mechanism driving this fracture, one that connects Dubai's $96 silver to collapsing derivative chains, sovereign debt crisis, and the end of dollar hegemony. And here's what it means for every asset you own. Let's break down exactly why physical silver trades at $96 in Dubai while COMEX sits at $41.82. Start with the supply chain. Dubai is a refining and trading hub for precious metals flowing from mines in Asia, Africa, and South America to buyers in the Middle East, India, and China. When you buy silver in Dubai, you're buying metal that's physically present in UAE vaults, cleared through local banks, and deliverable within 48 hours. COMEX is different. When you buy COMEX silver futures, you're buying a contract that promises delivery of silver at a future date. That contract is settled through clearinghouses using physical silver stored in COMEX-approved warehouses in New York, Delaware, and Chicago. Total registered silver in COMEX warehouses, 278 million ounces as of December 29, 2025. Here's the problem. Open interest in COMEX silver futures, 203,000 contracts. Each contract represents 5,000 ounces. That's 1.015 billion ounces of silver promised through futures contracts. But only 278 million ounces exists in warehouses to deliver. The ratio is 3.65.1. For every physical ounce available, there are 3.65 paper claims. Dubai doesn't run on fractional reserves. You buy silver, you get silver, no promises. No future delivery dates, no clearinghouse risk. The $96 price reflects actual supply and demand for physical metal in a market that requires settlement. The $41.82 price reflects betting on silver prices in a market that rarely settles physically. Sound familiar? This is the classic fractional reserve breakdown. As long as everyone rolls contracts forward and nobody demands delivery, the system works. But when buyers start demanding physical metal, which is exactly what's happening in Dubai, Shanghai, and Mumbai, the fractional reserve collapses. The paper price and physical price diverge, and the divergence reveals the lie. Now let's talk about who is buying physical silver at 96 cents in Dubai and why it matters. The buyers aren't retail investors or jewelry manufacturers. They're sovereign wealth funds, family offices, and institutional buyers. From Saudi Arabia, UAE, Qatar, and Kuwait, countries sitting on $4.3 trillion in combined sovereign wealth assets denominated in dollars, euros, and treasuries. These entities are experiencing what every bondholder is starting to feel: currency debasement through inflation that is running hotter than official statistics admit. Saudi Arabia's public investment fund holds $925 billion in assets. If real inflation runs at 8% annually, not the 3.2% official CPI, they're losing $74 billion per year in purchasing power. Even at official rates, they're losing $30 billion annually. They're rotating out of bonds and into hard assets, not as speculation, as preservation. When you hold $925 billion and inflation is destroying 3 or 8% annually, you don't care if silver costs $96 instead of $41. You care that it's physical, deliverable, and can't be printed by central banks facing fiscal emergencies. And here's where it breaks the derivative system. The same banks shorting silver on COMEX, JP Morgan, HSBC, Bank of America, are also primary dealers for treasury auctions and counterparties to Gulf sovereign wealth and currency swaps and interest rate derivatives. When Gulf wealth funds demand physical silver delivery, these banks face a choice: deliver physical metal and drain COMEX warehouses to zero, or default on delivery and destroy credibility with sovereign clients. They can't default. Sovereign wealth funds are too important as treasury buyers and dollar supporters. So banks are buying physical silver at any price, including $96 in Dubai, to fulfill delivery obligations. That buying pressure is draining global inventories while COMEX paper prices remain suppressed through future selling. The fracture widens. But the COMEX 5% overnight move reveals something critical. Even the paper market is starting to price in supply stress. A 5% move in precious metals is extreme volatility for a market that traditionally moves 1 to 2% daily. The spike came after Asian trading hours when physical demand is highest and COMEX inventories are most stressed. Here's the mechanism. Dubai closes, physical silver trades at $96. 8 hours later, COMEX opens, and arbitrage algorithms detect the spread. They buy COMEX futures expecting convergence, but convergence requires physical delivery capability, which COMEX doesn't have. So instead of prices converging, the algorithms drive COMEX up 5% while Dubai stays at 96. The spread narrows slightly, from 129% to 122%, but doesn't close. This pattern will repeat. Every day, Dubai trades physical at premiums. Algorithms will buy COMEX expecting arbitrage. Every day COMEX fails to deliver physical, the algorithms will drive paper prices higher. Eventually, COMEX silver approaches physical prices, not because physical falls, but because paper rises to reflect delivery failure risk. And when paper prices approach physical prices, margin requirements explode. Banks short silver face mark-to-market losses that trigger the same 34 billion emergency injections we saw 3 days ago. Except each intervention is larger than the last, because the short positions keep growing as banks try to cap prices. It's a doom loop. Suppress prices through shorting, prices rise anyway. Bail out shorts with printed money, inflation rises, more capital flows to silver, repeat. Sound familiar? This is the endgame of every fractional reserve system. Lehman Brothers in 2008, Silicon Valley Bank in 2023. They all collapsed when depositors demanded their money and the bank did not have it. COMEX is facing the same dynamic with silver. The difference is COMEX is systemically connected to the $640 trillion derivative market through collateral chains and cross-default clauses. Let's quantify what Dubai at $96 means for the global financial system. If physical silver's true price is $96, then industrial consumers are paying 129% more than reported COMEX prices suggest. Tesla uses 50 grams of silver per EV. At $41 COMEX, that's $66 per vehicle. At $96 Dubai physical, that's $151. Multiply across 1.8 million vehicles annually, that's $153 million in understated costs. Scale that across all silver-consuming industries: solar panels, electronics, medical devices, 5G infrastructure. If true silver costs are $96, but companies are reporting costs based on $41 paper prices, corporate earnings are systematically overstated. When the paper price converges to physical, which must happen eventually, earnings collapse, margins compress, and stock valuations crater. But it's worse for sovereign debt. Middle Eastern sovereign wealth funds buying physical silver at $96 are signaling they do not trust dollar-denominated assets to hold value. They're trading treasuries yielding 4.5% for silver, yielding 0%, because they believe the real return after inflation makes silver the better hold. That's a devastating vote of no confidence in U.S. fiscal policy. Here's the greed encoded into this fracture. Western banks need Gulf sovereign wealth to keep buying treasuries to fund U.S. deficits, but they also need to suppress silver prices to maintain dollar credibility and protect their derivative positions. These goals are incompatible. If they let silver rise to physical prices, it admits dollar weakness. If they suppress silver through paper selling, Gulf wealth dumps treasuries and buys physical silver in Dubai instead. They're trapped. And Dubai, at $96, proves Gulf wealth already chose physical silver over paper treasuries. The $4.3 trillion rotation has started. It's not visible in Treasury market data yet because it happens gradually through non-rollover of maturing bonds. But the signal is clear. The petrodollar system, where oil producers hold dollars and buy treasuries, is dying. The petrosilver system is being born. And here's the moral hazard that makes this unstoppable. Every sovereign wealth fund watching Dubai trade at $96, while COMEX trades at 41, learns the same lesson. Paper markets are fraud. Physical markets are truth. The rational response is to buy physical and refuse paper. The more entities that do this, the faster inventories drain, the wider the spread becomes, the more obvious the fraud. China's sovereign wealth already figured this out. Their silver imports surged 340% in 2024 compared to 2020. Russia's central bank disclosed 78 million ounces of silver reserves in 2024, up from 0 disclosed in 2020. India's imports hit 270 million ounces in 2024, the highest in recorded history. Every major economy outside the Western banking system is accumulating physical silver while refusing paper claims. The fracture isn't narrowing, it's widening. And COMEX's 5% overnight move isn't strength, it's panic. The paper market is desperately trying to track physical prices to maintain credibility, but it can't because delivery capability doesn't exist. Every attempt to converge through price increases triggers margin calls on short positions that require 34 billion bailouts paid for with printed money. Let's connect this to what it means for you. If you own silver through ETFs like SLV, you own paper claims backed by unallocated silver that may not exist in proportion to shares outstanding. The prospectus explicitly states that during extraordinary circumstances, the fund may suspend redemptions or settle in cash. Dubai at $96, while COMEX sits at 41, is exactly the extraordinary circumstance that triggers those clauses. When enough shareholders demand redemption, the ETF can't deliver physical silver at $41 because physical costs $96. They either buy physical at Dubai prices, which crashes their NAV by 129%, or they settle in cash at COMEX prices, which is fraud. Either way, paper silver holders lose. Physical silver holders win. If you own mining stocks, you own companies that sell silver at COMEX prices but could sell at physical prices. Pan American Silver produced 25 million ounces in 2024. At $41 COMEX, that's $1.25 billion in revenue. At $96 physical, that's $2.4 billion. The delta is $1,375 billion in unrealized revenue, 134% above reported figures. When miners realize they can sell directly to Dubai at physical prices, they'll stop honoring COMEX contracts. The paper market collapses instantly. If you own tech stocks dependent on silver inputs, you own companies facing 129% cost inflation that isn't priced into earnings projections. Apple, Samsung, Tesla all depend on silver sourced at COMEX prices. When they're forced to buy physical at Dubai prices, margins evaporate. Stock valuations built on 30, 50x earnings, multiples compressed to 10, 15x. A 60% correction isn't a crash, it's a revaluation to reflect real input costs. And if you own government bonds, you own IOUs from states that promised fiscal responsibility while running deficits funded by treasury buyers, who are now rotating into physical silver at $96 rather than bonds yielding 4.5%. When treasury demand falls, yields spike. When yields spike, debt service costs explode. The U.S. already pays $1.1 trillion annually in interest on $36 trillion of debt. A 1% yield increase adds $360 billion to annual costs. The fiscal position becomes unsustainable. Here's the engineered collapse. Western governments built a financial system where paper claims outnumber physical assets by ratios exceeding 3.1 in silver, 100.1 in gold, and infinity in currencies. The system worked as long as nobody demanded physical settlement. Dubai at $96 is the moment when settlement demands exceed supply capacity. The fractional reserve is breaking. The derivative chains are snapping, and the bailouts required to prevent total collapse are becoming too expensive to hide. The $34 billion injection 3 days ago bought time. The 5% COMEX move overnight bought credibility, but Dubai still trades at $96. The spread still reveals the fraud. And every day the fracture persists. More capital flows from paper markets to physical markets. The rotation is unstoppable because it's driven by rational self-interest. Own the real asset, not the paper claim. The Western financial system is built on trust that paper claims will be honored. Dubai at $96, while COMEX sits at $41 is proof that trust is dying. Once trust breaks, markets don't heal through intervention. They reset through default, devaluation, and wealth transfer from paper holders to physical holders. That reset is happening right now in real time across precious metals, and it will spread to every asset class connected through derivative chains. Denial won't protect you. Hoping the spread closes won't save you. The institutions that built this fractional reserve system, central banks, bullion banks, clearinghouses, are the ones profiting from the fraud. They're not going to fix it. They're going to print money, suppress prices, and extract maximum wealth before the system collapses completely. But you've seen Dubai at $96. You understand the COMEX 5% move. You recognize the fracture. The question is whether you position for paper convergence or physical reality. So here's the final question. Are we wiser now, or are we walking the same path in better suits? Drop your thoughts below. Share this with someone who thinks ETFs and futures are the same as physical metal. And subscribe, because when the fracture becomes a chasm and paper markets freeze while physical markets moon, you'll want to understand which assets survived and which vanished into accounting fraud. Dubai chose physical at $96. COMEX pretends paper at $41 matters. Choose which reality you believe.